During these news conferences, the bank's governor usually carefully chooses his words. Today, the word crisis jumped out. With its latest interest rate cut, the Bank of Canada warns the trade war launched by the United States will push Canadians into troubling territory.
We are now facing a new crisis. Depending on the extent and duration of new U.S. tariffs, the economic impact could be severe.
The central bank is trying to keep inflation down by announcing an interest rate cut of 25 basis points to 2.75%. That's the 7th consecutive drop in a year. The cuts are meant to encourage spending, but costs are expected to rise with tariffs as supplies that Canadian companies need from the U.S. will become more expensive.
A trade war is a supply shock. It's going to disrupt supply chains. It's going to affect production costs and production capacities.
Last month, the bank surveyed hundreds of Canadians. It found that many companies had lowered their sales projections and were considering layoffs. Nearly half of the businesses planned to increase their prices, while customers were planning to spend less. Workers in mining, manufacturing, and the oil and gas industry felt most vulnerable.
Monetary policy cannot offset the impacts of a trade war. We're going to get weaker economic activity. We're going to get higher prices, higher inflation.
Unless the U.S. drops or limits its protectionist measures, economic growth could stagnate.
A 1% shock to GDP would pretty much put us in a crawling position and thus a recession. So it's definitely we're waiting to see how the economic data comes in.
In this trade war, the Bank of Canada is implying that it's fiscal policy that will matter more. Controlling inflation will depend on what politicians decide to cut and where they decide to spend.